Alrighty, folks, I apologize for being 3 or 4 minutes late. It is never my intention, but sometimes technology gets in the way. Yes, I had to reboot my VPN and router and all kinds of stuff this morning for some unknown reason, so I apologize. But let's get into the topic at hand. I have to tell you about a video that I saw yesterday that frankly scared me. And this is coming from the guy who has been telling you higher for longer. In fact, for much of the year, I talked about interest rates averaging over 7%. I did walk that back a couple of weeks ago, probably too early, but I want to tell you about an interview done, and you should research this. Kamal Shri Kumar. Let me try that again. Kamal Shri Kumar was interviewed on CNBC. It's about a 5-minute interview. You can certainly find it on YouTube. But this individual has a base case for the 10-year note in 2025 being 5%. Now, given current spreads, that would mean mortgage rates for owner occupants are above 7.5 and frankly approaching 8. Investor loans would undoubtedly be in the 8% range. Now, that particular call, frankly, doesn't scare me. The one that scared me is what he said next. And if he's right about this next piece, it will be a housing market catastrophe. Which again, always remember, if we're investors, frankly, that's a good thing. Right? A housing market catastrophe means great deals are everywhere. Motivated sellers are nearly everywhere. And we, frankly, don't care about the cost of capital. But I digress. Let's get back to the call that freaked me out. Again, Kamal Shri Kumar, gosh, why did I mess that up? Said that the risk to his base case, which you got to remember was 5% on the 10-year, was to the high side. He said he could see the 10-year note getting to 6% in 2020. This year. Now, let's just play this out together. If the market gets so wild that we now have a 10%, or I'm sorry, we have a 6% 10-year, you're going to have owner-occ loans approaching, if not hitting 9%, because maybe the spread expands, which means investors might get 10%. There's a lot of things going on in the system, and it doesn't take a lot of things to go the wrong direction to see how we might have 9% mortgages in 2025. Now, again, not my call. Frankly, I have to tell you, I never even thought about 9% mortgage rates. It was like not even on my radar. But now, it's not crazy. And again, remember what I've said for a long time. We have learned historically that in order to pull demand off the sidelines, you need to be 6.5. Can you think about what happens at 9% mortgages? My call for sub 4 million transaction is going to be freaking looking like easy, like a layup. Anybody that is thinking about housing, first-time home buyer, move-up buyer, the market would just stop. And again, as I said earlier, but again, we are one rental at a time, right, folks? We are going to clean up because, again, what will we do? We will have a buy box. We will write great deals. We will follow up. We will write deals that cash flow day one. Also, you know what happens at 9% mortgages? Sellers get creative. They'll hold seconds. They'll hold silent seconds. They'll seller finance. This is going to be a repeat of what if we get to 9%, and heaven forbid 10% for investors, right? If owner occ is 9%, investor loans could very easily be double digits. Think about that for a minute. Think how broken the commercial real estate market will get at 10% mortgages. I can't even fathom how broken it would be. But I digress. This will be 2025 again, higher for longer. Said that all year. Real estate transactions, existing home sales below 4 million. and again, the year of the investor. Again, I want you to just remember that. Yes, it's chaotic. Yes, it's scary. But as investors, it's our job to find motivated sellers. It's our job to create good deals. So just keep your head down and keep doing the work. Let's congratulate some people. I meant to do these yesterday. I apologize. It got away from me. So let's do them today. Renee, congratulations for getting your next deal. Your card will be going out in the mail. And then Dan, congratulations on getting your first deal following One Rental at a Time or ORAT. Again, folks, you can get your gold card for your first deal, and you can get as many of these black cards as you would like. I want to recognize investors who are doing the work and going that extra mile. Love to send you a card. I'm an easy grader. You got a house hack, you got an ADU, whatever. I want to recognize you if you are doing the good work. So again, do yourself a favor. Kamal Shri Kumar scared the bejesus out of me. It really could be a housing market catastrophe. Again, remember, opportunities are found in that area. Let's switch gears. Let's get a little happier. Let's talk about something not so dire. How about Kevin Hessent? He is the National Economic Council Director. So he is part of the administration. He says, and I quote, 10 countries have made amazing trade deal offers already. Also, Kevin went on to say, we will 100% not face a recession this year. So you can see that Kevin is very confident with that 100% call that we will not see a recession. On the flip side of that, Kevin, just so you know, I'm sure you saw this, 62% of U.S. CEOs expect a recession. Yeah. Again, folks, why is that important? Because, again, one leg of the economy is private enterprise, a.k.a. business. And if 62%, let's just call it two-thirds, nearly two-thirds are expecting a recession, CEOs will pull back on investments. They will hire less. It's just how the system works. As somebody who was part of an accounting organization who routinely worked with the CFO and CEOs, I can tell you the recession playbook. They pull back immediately. They conserve cash. They delay payments. It's just one big game. New York Fed survey out with some pretty startling data. 44% expect jobless rate to be higher at the end of the year. I think that is a, frankly, layup. Again, we are at historic lows. So saying you're going up from historic lows is probably not that big of a call. U.S. consumer sentiment plunged 11% to its lowest level, second lowest level since 1952. The reading came in at 50.8. Just so you know what the low was, it was 50, a flat 50. That happened in June of 2022. So again, I keep highlighting this. The U.S. economy is three stools. You got government, you got private enterprise, and the big boy, consumers. And boy, consumers are not feeling good at the moment. I think we should start talking about soft data and hard data. I think you're going to start hearing a lot about that. In fact, you probably have already over the last 30 days. So what does it really mean? Soft data is kind of expectations. It's forecast. It's what do I think will be happening in 1, 3, 5 years? Soft data is, frankly, a whole lot of feelings. What is the interviewer or interviewee feeling at the moment? Are they scared? Are they conservative? Are they going for it? What is going on? Hard data is always in the rearview mirror. Think about tomorrow. Tomorrow's Wednesday. I think tomorrow's retail sales. Retail sales is hard data. Unfortunately, hard data is frankly useless in the environment we currently find ourselves in. I think any hard data that comes out pre-Liberation Day is frankly useless, just absolutely garbage and irrelevant. The only hard data that's going to make any sense is stuff we get 30, 60, and 90 days from now. The world changed. The economy changed on Liberation Day, and we have not seen the impact in hard data. It's coming. It's going to be slow and quite possibly ugly, but we will have to get there before we find out. Waller, we got a lot of Fed talk. We got Fed President Waller. Recession risk would outweigh risk of higher inflation. Folks, you've been following my channel for any number of years. You know that's probably what Arthur Burns thought before Paul Volcker kicked him out and he had to raise rate. Basically, what Waller says is, hey, if the economy breaks, we will slash. Inflation be damned. Again, double dip or double peak in inflation. Go look at the charts. You know, I have that 50-year chart on my website, onerentalatatime.com. Go get it. All it needs is your email. It will send you the file. Go look at what happened to inflation. Inflation ripped. It started to look better. Arthur Burns cut. Inflation ripped higher. It was the ugly double dip or double recession, back-to-back recessions. That second one was particularly painful for yours truly and yours truly's family. That sucked. 82, I think it was, 81, 82. That one sucked. Fed President Waller says limited impact if tariffs average under 10%. If you don't know, folks, we are currently at roughly 25%. We are higher than Smoot-Hawley. Smoot-Hawley took us to 20 or 22% back before the Great Depression. We're at a blended average of 25%. Now, most of that obviously is because we have China at 145%, but hey, we used to get a third of our stuff from China, so it makes sense. We'll see if that is true going forward. And Waller said, if we continue to have this tariff policy, inflation could hit 5%. Heaven forbid the economy slows, they cut rates. What happens to inflation then? It's going to be interesting. Deutsche Bank out with an interesting call on interest rate cuts. Deutsche Bank has changed their opinion. They now see only one cut this year, and it will be in December, followed by two cuts in Q1 of 2026. So again, very much lots of stuff going on. I did find it interesting that Scott Bessent said, we are starting to interview for Jerome Powell's replacement. That's got to give you all kinds of warm and fuzzies, right? I believe Jerome Powell is out in April of next year, maybe May, something in first half of 2026. So they are already interviewing for his replacement, which I thought was odd. Fed Governor Waller also says tariff inflation is transitory. Man, could you guys find a different word? Have you not learned anything from last time? It's crazy. Says that inflation could spike to 4 or 5%. Slow growth and unemployment will increase. CNBC put out an article the other day talking about manufacturing is not coming to the United States. That's crazy. Companies will simply go low tariff globe hopping versus coming back to the U.S., to which I remind you that NVIDIA just yesterday said they're going to have plans to produce up to 500 billion, let's call that $500 billion, in AI infrastructure in the United States over the next 4 years. They are building 2 additional plants in Texas, one in Houston and Dallas, and they've started to roll stuff out in Arizona. So again, certainly probably both true. You're going to have some companies go globe hopping for low price, low margin stuff, but we are seeing manufacturing in what we consider to be national security, i.e. AI chips, come home. And I don't think anybody could see that as a bad thing. Morgan Stanley says, expect to be fooled many more times on tariffs. I think this is just the realization that nobody really knows what's going on except Trump, and maybe not even Trump himself. But hey, we're going to be fooled some more times. So keep your P's and Q's tight, keep your stop losses tight, and make sure you don't get got. I thought it was interesting that small businesses are suing the federal government and Trump, saying that trade deficits are not a national emergency. Folks, if you don't know, President Trump leveraged his ability to implement things that are national security without Congress's approval. And apparently some U.S. businesses have cobbled together a coalition to actually sue and say trade deficits are not a national emergency. I think that is an interesting thing to do. But again, I think we have historically given presidents pretty wide berth to declare what a national security is. national security risk is, so I'm not sure that goes anywhere. But hey, you do you. That's why we have the rule of law. What else do we have to say? What else do we got? Yeah, let's talk about one more thing as we wrap up this thing. And again, remember, go check out that interview with Kamal Shri Kumar. It scared the bejesus out of me. It really could lead to a U.S. housing market catastrophe, aka opportunity for investors. Actually, I'll see if I can find the link and post it in the show notes, see if YouTube deletes it or not. But let's talk about demand destruction. Right. One of the things that we just talked about in today's episode from President Waller was that tariffs would create inflation potentially high as 5%. There is a counter argument to that. What could also happen? The consumers could frankly revolt and refuse to engage in the economy. That is called demand destruction. So if you play the game of demand destruction, right? So you're a company, you import stuff, you have to raise prices 5%. It goes from $10 to $10.50. However, the consumers refuse to play. What will happen? Supply, aka inventory, will build. At some point, the operator will realize that nobody is coming in for this item at $10.50. And they will have to slash prices. And if this happens enough across the company or across the country, you could actually lead to deflation. So there is a non-zero chance. It's probably double digits, probably like 25 to 35%. That what actually happens on the other side of tariffs really working themselves into the country, into the economy. This is probably 90 days out. It won't be immediate. But we could actually see deflation. Now, I think it's fair to say we will certainly see deflation in some segments. Maybe it's clothing, maybe it's furniture. I don't know what it is, but something. But again, there is a non-zero chance that deflation is the story of the day come, say, July, August. So again, folks, lots of stuff going on today. We got to watch the 10-year note. If Kamal Shri Kumar is right and we go to 6%, I think all kinds of shit breaks at 6%. Can you imagine Scott Bessent refining the national debt at 6%, not 4%? Can you imagine what happens to small businesses? Can you imagine what happens to car loans? Can you imagine what happens to credit cards? I could not fathom how bad it gets if we have 6% 10-year note. But hey, if it comes, we will be ready. Fixed rate debt, cash flow day one, make your money when you buy. This is 2025. 2025 is the year of the investor. I will keep saying that until you believe it yourself. And if you want to get in a community that is like-minded, you got to join School. One rental at a time in School. School is SKOOL. 67 cents. Actually, somebody did the math for me yesterday, and it's actually 66 cents a day when you take $20 a month and you do it over 365 days. It is actually 66 cents a day. So, hey, I rounded up to be not called a cheat. So there you go, folks. Join School. I'll see you there. Remember, Sunday, I'll be going live, so you can come in, ask me any questions, real estate, economy, YouTube, health journey, whatever you want. Take care, and I will see you tomorrow at 7:30 a.m. Again, I apologize for being 4 minutes late. I had to reboot my VPN and router. It wasn't fun. It was very stressful, but we got it done. Later.